Soft Currency Economics by Warren Mosler. The Fed Funds Market. The Fed Funds Market is a means by which banks can obtain funds from other banks or non-bank lenders, such as U.S. government agencies, savings and loan associations, mutual savings banks, or an agency or branch of a foreign bank. Federal funds are unsecured bank loans. Federal funds do not belong to the federal government, as the name might suggest. Fed funds are not subject to reserve requirements. They are, in effect, reserves traded among financial institutions. Member banks have reserves in the Fed, which are also known as immediately available funds, since they can be transferred almost instantaneously over FedWire. FedWire is the Federal Reserve System that electronically transfers funds and securities on its communications network. Money and securities are no more than accounting data. A bank can access its account at its reserve bank to transfer funds or securities to any other depository institution that has a reserve bank account. When banks borrow Fed funds, they are actually borrowing deposits from other banks. The transfer of Fed funds increases the deposits at the borrowing bank and reduces deposits at the lending bank. Most Fed funds borrowing is for 1 day. Essentially, these borrowings are 1-day unsecured loans. Banks could obtain funds by selling treasury bills, either outright or as reverse repos, but for 1 day or a few days, such sales are less convenient and slightly more costly than Fed funds. No matter what the method of acquiring funds, bank reserves are simply transferred from one bank to another. Interbank reserve transactions change the location of reserves, but do not alter the total amount of reserves held in the banking system. Banks may obtain funds in the Fed funds market to maintain their reserve requirement. They have lines of credit with each other to enact direct transfers of funds. Banks have been known to borrow Fed funds continuously and in excess of their reserve requirement when it is profitable to do so. Banks may borrow beyond their reserve requirement and lend the borrowed funds at higher rates than the cost of borrowing. The difference between a bank's cost of money and the return on loans determines its willingness to lend. The cost of money defines the cost of loans, and thus the demand for loans.